What is a liquidity trap? We use the term liquidity trap when talking about a national economy. If the central bank wants to boost spending, it may lower interest rates. Sometimes, however, the measure does not result in greater spending. A liquidity trap occurs when monetary policy does not work. Monetary policy refers to the central bank's activities to boost the economy or to slow it down, such as lowering or increasing interest rates. Fiscal policy refers to taxation and government spending. The risk of a liquidity trap grows the nearer interest rates are to zero. If you want to increase spending and interest rates are near zero, your options are very limited. In some countries, interest rates went below 0% when their economy was in recession. If lowering interest rates doesn't work, the central bank may inject money into the private banking system to lower long-term interest rates. If this fails to lower long-term interest rates, the threat of a liquidity trap grows significantly. Sometimes individual citizens and banks become averse to taking risks. They are afraid of borrowing money and buy things only when they have enough cash. In such a situation, despite all measures, the country is trapped in a recession. The Reserve Bank of Richmond in the United States says the following about the liquidity trap: a situation in which people have a virtually endless demand to hold cash, an endless demand for liquidity relative to other assets. In that situation, the central bank's increases to the money supply fail to translate into increased consumption or investment to get the economy churning because the private sector simply holds onto the cash. Economists say that the most glaring warning sign that a liquidity trap may not be too far away are extremely low interest rates. Bondholders become concerned about super low interest rates and start selling in a way that is bad for the economy. A liquidity trap is the opposite of a credit crunch. In a credit crunch, borrowing is hard to get and expensive. In a liquidity trap, on the other hand, borrowing is easy, plentiful, and extremely cheap.